You're live?
Yeah. All right.
Great. Now,
Hey,
let's get that frame right. Brother, would you like to sit or stand?
I tend to walk around when I talk.
I want to try and catch the whole presentation, inshallah.
That's it.
Yeah?
So I'll probably walk around a bit here so I don't go in front of the screen.
Yeah.
Okay, now I need to do one last thing. I need to share it. Where should we share it? Where do you want me to share it, guys?
We'll see you
If you give me the
YouTube.
I'll put it on the circle one first, and you take it from there.
How far wide does the framing go? So I just know how much I can
It goes-
paste. If I'm around here, am I okay?
Just give me one second, I'm looking at the wrong thing. Right, hold on. We are live. And okay, now Master, you can guide him.
Yeah.
So that's
Yeah,
pretty
that's
much
pretty
your
much
that's your end on this
That's
side.
the end, okay.
And
And then
over
I
there
can
is the end
paste
of
this.
the end of the screen.
That's fine. I'll try not to cover the screen. I'll just pace around a little bit here.
Yeah.
Okay.
So you do the-
All right. Bismillah. Okay, I'm the tech guy. I'm suddenly the tech guy. Okay. All right. So it's two mics, and if anybody has questions, Ronald said, if anybody has questions, just pass this around. Okay.
we'll do that at the end, right?
Yeah.
Yeah, we'll
but,
do questions
you know.
at the end, inshallah.
Okay. So what am I looking at for the? Okay. Bismillahir Rahmanir Rahim. Alhamdulillahi Rabbil Alameen. Wa sallallahu ta'ala wa sallam ala Sayyidina Muhammad wa ala alihi wa ashabihi ajma'in. Amma ba'd. Welcome, brothers and sisters who've come. Inshallah, jazakumullah khairan for attending and making this type of event a success. And also welcome to our online audience, whoever you are, jazakumullah khairan for attending. Today's event is a presentation by an organization, a company called Pfida. They used to be known as Primary Finance, right? And they rebranded to Pfida with a silent P, I must add. Right, Pfida with a silent P. This is a little quirk in their branding. And I think I read up on it when you guys changed it. The silent P is an acknowledgement of the acronym of the original brand, right? So Primary Finance, do you understand? And the new brand has silent P, so the PF is still in there. But anyway,
But the P also stands for people, because we want to bring Pfida to the people, inshallah.
So with me and with us is Brother Razaullah, who is CEO and founder of Pfida. He's a qualified actuary by profession with over 17 years of actuarial experience. I hope I said that right. Brother Raza has previously worked within consultancy at PricewaterhouseCoopers, where he advised multinational blue chip organizations on technical reserving processes and capital validation. Give me fiqh and I'll be fine. This stuff. Okay. And he's worked in-house within the Lloyd's of London marketplace as a technical capital modeling actuary, utilizing stochastic, all right? Stochastic Monte Carlo simulation methodologies to quantify risk based on thousands of calibrated possible outcomes. He has further gained regulatory experience at the Bank of England's Prudential Regulatory Authority, where he was a risk specialist overseeing best practices across the industry for risk measurement and quantification. I'm starting to see some patterns.
Done a
now.
great job, mashallah.
I'm starting to see some patterns about the way you do things now. So how many times did I say the word risk? Okay. And Brother Raza progressed rapidly through to senior roles within the London financial marketplace, having passed every actuarial exam first time and within 3 years, which is a very rare accomplishment. Consequently, he saw how different businesses work from the lenses of consultant, in-house specialist, and regulator, and across many different levels of the way up to high-performing boardrooms. Brother Raza gave up his full-time actuarial career in 2016 to pursue setting up and running Pfida and bringing a revolutionary solution to a real-world problem. Now, a couple of words from me. So, obviously, why is Pfida here, right? Islamic finance and Islamic home purchasing solutions have been around for a while, right? And they have, and in some ways continue to be out of the reach of many. And the question of what is the halal way to purchase a home is something that some people, it's been absolutely at the forefront of their minds, right? Because they will not opt for any other solution. That's people like myself. And then there's other people who are looking for some sort of an answer from scholars, right? Whatever that may be, but an answer from scholars so that they can pursue scholarly guidance. And others have just decided for themselves that this ain't working for me. I'm just going to take a mainstream mortgage. As Muslims, like everything else, we need to be concerned about the halal and the haram and the permissible and impermissible, because what is it about? It's not some sort of random concept. These things are about the commands of Allah subhanahu wa ta'ala. It's about what Allah subhanahu wa ta'ala has told us to do and what Allah subhanahu wa ta'ala has told us not to do. Among the things Allah subhanahu wa ta'ala has prohibited, one of the most serious, right, is dealing in interest, right? Receiving and paying of interest in our dealings. And therefore, any solution, whether that's the fatwa of a scholar saying, okay, because of X, Y, and Z situation, you may go and buy a house with a mainstream mortgage, which some of you may or may not have heard of these fatwas, but there's a certain discomfort around that. I personally had. I respect the fatwas of ulama generally, even if I disagree with them, right? Some of you have come to me and I've said, if you're willing to take this fatwa up, I'm happy to at least tell you that it's permissible for you to take it. But there is a certain discomfort, all right, because of the fact that interest is still involved and we are still paying interest. And therefore, true Islamic finance solutions are, they're fundamental, right, to our ability to do something so significant and pivotal in our lives, which is purchase a property. And it's not materialism to want to buy a property. One of the most fundamental things that the Sahaba had, despite their apparent poverty, which sometimes we talk about when we speak about spirituality, is they had servants and they had land. Those are two things they all had. I often, when people talk up this idea of, the Sahaba live like this and look at us with our cars and etc. etc. I say, look, yes, they did, and yes, they did struggle for Islam and they sacrificed for Islam and they did all of those things for Islam, right? But they didn't absolutely sacrifice their quality of life. There were things that were important to them. They were rich among them. They were poor among them. They were like us. They were like us, but their hearts were clearly tied to the akhirah. Part of that was that when it came to their financial dealings, even if it meant that they became rich, they obeyed the commands of Allah subhanahu wa ta'ala as part of their commitment to the akhirah. And therefore, we need solutions like this. When FIDA came along, I actually knew something was cooking for a few years because I know Sheikh Salman, who is one of the directors, correct? And also he does all of the Sharia compliance work. And I knew he had criticisms of the existing Islamic finance solutions. He was worried that they weren't quite Sharia compliant enough. We had lots and lots of conversations about that among imams and among ulama. And he said something else needs to happen, something else needs to be done. We need something that is more compliant, right? That we can confidently say this is halal and it addresses all of the problems that other systems have. And you can ask Brother Raza about this. I'm sure he'll be able to discuss them. And then primary finance came along, right? It was for a lot of people who had been waiting, it was refreshing. Around the time that I was coming to Chelmsford, I immediately took measures to basically to apply and so on. And then it was actually because of these guys that I managed to buy a house in Chelmsford, right? And it, he'll tell you what the system is, but everything they told me is how it happened. Okay. So with that much said, I'm going to now hand over to Brother Raza because he's the main man here.
Jazakallah khair. Thank you so much, Maulana Shams. So I like to stand up when I present. Okay.
I'm going to sit over there.
Of course.
So I can see you.
So, mashallah, Maulana Shams has already spoilt the icebreaker, which is where I get people to guess how to pronounce our name. I think you guys have already heard the answer, but who remembers how to pronounce the name of our organization? FIDA, exactly. And who here knows what the word FIDA means? Benefit, in multiple different languages. So the word FIDA means goodness or benefit in a multitude of languages. Arabic, Persian, Turkish, Urdu, Bengali, Hindi, lots of different languages. The word FIDA means goodness or benefit. And as Maulana Shams already alluded to, the P at the start is a silent P, and it stands for people, because the idea behind FIDA is to always bring goodness or benefit to the people, inshallah. And it's also a nod to our previous name, how we used to be called Primary Finance, the PF. Okay, so let's get into it. Maulana Shams has already done a great job introducing me. Alhamdulillah, jazakumullah khaira for that. I will talk a little bit about my story and how I came to setting up FIDA. So rewind back to 2015 when I was working at the Bank of England, and I remember sitting next to a young lad called Elliot Luciani Kane, 20-something-year-old, fresh out of university, non-Muslim chap. And I remember sitting next to him as an actuary working in the Bank of England. And by the way, who here has heard of an actuary? Who here knows what an actuary is? Okay, probably 10% of the room. That's about normal. Actuaries, just by way of very, very high-level introduction, there's not very many of us. Actuaries, it's a fairly rare skill set. We're effectively advanced statistical modelers. We work for financial institutions. We help to quantify risk, as Maulana Shams said, cottoned on. We help financial organizations to measure what risks they're exposed to, turn that into a monetary figure, and work out how much money they need to hold to stay solvent effectively. So because there's not very many of us in the world, as a result, actuaries are very high in demand, and actuaries tend to get paid very, very well. So alhamdulillah, I had a very, very high-powered, very, very successful career in the City of London. And I remember sitting next to Elliot back in 2015 when I was at the Bank of England and saying, you know, Elliot, we actuaries earn a ton of money. And my plan is, by the time I'm 40, I'm going to own a property portfolio and I'm going to retire off of the rental income. And that was my plan at the time. And subhanAllah, you know, that was what I wanted to do. But Elliot wasn't happy with this. Elliot, this 20-something-year-old, fresh graduate, non-Muslim, literally, we using this? Okay. So Elliot, this 20-something-year-old, fresh new graduate, literally wagged a finger in my face. And he said, you know, Raza, what you're talking about is going to deepen the housing crisis we're already in, because it's going to make properties even more expensive and it's going to take up housing supply. Whereas with an actuarial skill set, you have a responsibility to fix it. Now, he didn't say you have the ability to fix it. He said you have a responsibility to fix it. And Elliot's finger wagging struck me like a ton of bricks. And I realized that he was actually schooling me in my own Islam. He was saying, in his own words, Allah has given you a skill set, Allah has given you a ni'mah. You have a responsibility to do something beneficial with that and use it in Allah's name, rather than just living for yourself. And subhanAllah, I'd never thought about this before, and it took a non-Muslim new graduate to remind me of this. So later that same year, with this seed already planted in my mind, Allahu Akbar, Allah invited me to his house. And I went on the miraculous journey of Hajj. And I remember standing in Hajj on the day of Arafah with my hands raised to the sky. It was 50 degrees that day, and I was under the shade of a lonely tree. And I had my hands raised to the sky, making dua on the day of Arafah. And I started having a conversation with my Rabb, and I started saying, Ya Allah, you've given me everything I could possibly ask for. Health, wealth, iman, intellect, and this actuarial skill set, which not that many people possess. Ya Allah, what will I say to you on that day when you ask me what I did with it all? And I remember being embarrassed, and I remember being ashamed, and I remember being terrified. Because I realized at that moment on Arafah that the answer I had, I didn't feel it was a very good one. I was embarrassed and ashamed to stand in front of Allah on that day and say, Ya Rabb, you gave me everything. And I used it to buy a nice car and a nice house and to take my family on holidays. And that was the pinnacle of what I achieved in my life. And I remember thinking, gosh, I do not want to stand in front of Allah that day, and that's all I can say. And I remember repeating again and again, Ya Rabb, what will I say to you? Ya Allah, what will I say to you? Ya Allah, what will I say to you? And I'd never been so afraid in my life. And I started crying and trembling and shaking like I've never cried and trembled and shaken in my life. And I remember tears rolling down my cheeks onto the sand. And I remember there literally being a puddle around my feet from the tears I was shedding because I was so terrified of my Rabb on that day. And I realized at that moment that I needed to have a better answer. I realized at that moment that I needed to be able to at least say, Ya Allah, I tried to do something to please you. Maybe I failed, but at least, Ya Rabb, I tried. And maybe in Allah's mercy, that will be sufficient. Whereas up until that point in time, living for myself, I realized maybe that wouldn't be sufficient. So that was a point in time when I realized I needed to do something about it. And so I came back from Hajj. I ended my role at the Bank of England and I started setting up FIDA. Now, initially, I didn't know what I was going to do. I didn't have this idea of FIDA in my mind, but I knew I wanted to do something. And I thought about doing charity work, and I realized there's plenty of good charities out there doing great work, and maybe it's not my calling in life. And then I rewound to this conversation with Elliot, and I thought, right, the housing market, this is where I can actually put my skills to use and do something useful. And so that's when I started building the model that we have today. Now, it's important to understand at this point in time, I'd never picked up an Islamic finance text in my life. I didn't know Islamic finance, but I knew finance, I knew economics, and I had common sense. So I used a common sense approach with my understanding of finance to start putting together the very product that we offer today. And then I realized, okay, once I'd started all the design, I realized, okay, I need a Sharia scholar who can help me decide if this is even halal or not. And that's when I was put in touch with Sheikh Salman. I normally hand over to Sheikh Salman at this point to tell his story, but long story short, we had met previously. He was actually my Arabic teacher 10 years before this point. And I only knew him as an Arabic teacher at this point. What I didn't realize is, mashallah, what a gem I had been introduced to. Sheikh Salman is not only an English qualified lawyer, he's also a Sharia scholar and a student of fiqh. And so when I was looking for the right kind of Sharia scholar to help me, I realized I needed both of those skill sets, and I realized I was looking for a needle in a haystack, because being an English qualified lawyer is a lifetime profession in itself. Being a Sharia scholar and a master of fiqh is a lifetime in itself. Finding someone who's experienced in both, needle in a haystack. And I had some people put me in touch with banking and finance lawyers who didn't understand fiqh, and I had some people put me in touch with shuyukh who didn't understand banking and finance. And then it was a good friend of mine at the Bank of England who leads the Islamic finance practice there, who said, you should speak to Sheikh Salman Hassan. No, sorry, he said, you should speak to Sheikh Badr al-Hassan. And I didn't know who Badr al-Hassan was, and that was actually his legal name. I knew him as Salman Hassan. Long story short, we got on a call together. We realized we already knew each other, and I asked him to come on board as my co-founder in the business. So that's a bit about me and Sheikh Salman, a bit about our backgrounds and why we decided to do what we're doing. What I want to actually spend today doing isn't necessarily just talking about FIDA. I will talk a bit about FIDA, but really today is about education. Today is about raising awareness of all the different available methods on the market that Muslims have at their disposal for buying a home. And we're going to go through the different options available, inshallah. I'm going to spend about 40 to 45 minutes presenting, inshallah. And then we'll have Q&A at the end, and it depends how many questions you have. I'm happy to stick around for as long as you need me, inshallah. There's also a freebie at the end. So at the end of this, if you stick around, inshallah, we've got a 27-page ebook on Islamic finance, which you'll get access to at the end of this as well, inshallah, and that will cover a lot of what we're going to discuss today. But I'm going to go through all the options, starting from a conventional mortgage, a ribawi mortgage, going through Islamic bank mortgages, going through co-ownership products, and also the FIDA product as well, inshallah. And by the end, inshallah, this is an introduction. It's not a detailed, advanced course, but by the end, inshallah, I hope you will all have a very good understanding of the differences between the different products on the market, and the things you should be aware of and consider when looking at what is the right option for you to buy a home. I'm not here to say the FIDA model is the best and all other models are rubbish. I'm not here to say you should take this option and not that option. I'm here to provide you guys with the tools and the knowledge to, inshallah, make your own informed decisions. Anything I say today with regards to other products, I want to be very, very clear. I am not here to insult other products. I'm not here to give a Sharia opinion on other products, but I am here to talk about some of the pros and cons and things you need to be aware of with the different products out there. So first of all, this is a slide that Sheikh Salman would normally present as the resident Sharia scholar, but I'm going to cover it as well, inshallah. So there are certain fiqh principles you need to understand. This is your base level of knowledge when considering any financial product. And they can be split roughly into three key principles. The first is, what is the difference between rent and riba? It's very important you know how to distinguish. So when you're looking at something and it's called rent, is it really rent? Or is it actually, one of the big criticisms, rightly or wrongly, that Islamic banking products get is, oh, the rent is just riba, called a different name. Well, I'm going to arm you with the tools to help you understand what the difference is, so you can make your own informed decision. Risk sharing. In the Sharia, Islam encourages partnership rather than debt. Now, there's nothing wrong with debt. You can have something called the qard hasana, a beautiful loan, where somebody loans money to you and they don't ask for anything in return, and you pay that money back when you're able to. This is a beautiful transaction in Islam. But where you have a debt-based obligation where you have to pay money on top of that, that is riba, and this is heavily discouraged in Islam. And so financial transactions under the Sharia generally encourage partnership rather than debt, and I'll get into that. And then the other key principle to be aware of and make sure you're not falling foul of when considering Islamic financial contracts is a prohibition in Islam of having two contracts of sale in one. And again, we'll go into that in a little bit. So first of all, I want to put it to the room. When you're renting a property from a landlord, it's very clear you're paying rent, right? You're renting a property from a landlord. Nobody would say to you, oh, no, you're paying riba. And yet, on the other hand, when you are paying a mortgage from Barclays or HSBC, you know inherently that you're paying interest on a loan, right? Nobody would come and say to you, no, this is not interest, this is rent. So I want to put it to the floor. How do you know when you're renting from a landlord, you're paying rent, and when you're paying interest on a Barclays Bank mortgage, you're paying interest? What is it that distinguishes? Because none of you need an education in Islamic finance to just inherently know when you're renting from a landlord, you're paying rent. When you're paying interest on a mortgage, you're paying interest. You don't need a background in Islamic finance to know this. You already know it. Inherently, it's in there. But what is it that distinguishes? So I want to get some ideas from the crowd before we go into this, inshallah. Why is rent rent and why is interest interest? The contract you sign, okay. What specifically about the contract? How do you know when you're renting from a landlord, the rent in your contract is actually rent and not interest? You inherently know it's rent. You know it's rent. But why? What is it that makes it rent and not interest? Yeah. Okay, so the sister here said in the contract it says that it's rent, otherwise it would have an interest rate. But what if Barclays Bank in their mortgage contract wrote, you have to pay 4% rent on your mortgage? Would you say, no, this isn't interest, this is rent? Or would you say, actually, I don't care if you're calling it rent, this is still interest? If you had a Barclays Bank mortgage, right? If it's called rent in the contract, does that mean it's rent? No. So it doesn't matter what the name is. This is very important. I could call, who was I was saying to earlier? I think it was Brother Nasser. I could call this rent. I could call this interest. It doesn't matter what I call it. What's important is how it behaves, right? Okay, any other ideas? Yes.
You're paying a specific amount and it doesn't increase like less than midway.
Interesting. Okay. So the brother talked about you're paying a fixed amount. It doesn't increase. We'll come back to that, inshallah.
It's based on the use of the asset.
Bingo. The use of the asset. Right. Now we're getting somewhere. Okay. When you're renting a property from a landlord, do you own that property? No. If I own a car, can I rent my own car from myself? Doesn't make any sense, does it? I can't rent something I already own. So, when you're renting from a landlord, you are renting an asset you don't own. The landlord owns the asset, and the landlord takes all of the risk in the asset. What do I mean by this? If that property is destroyed, do you own anything? Do you owe anything? If the property is, no, you don't have any risk in that asset. Who takes the loss if the property is destroyed? The landlord. Perfect. Now let's look at the other option, a mortgage. When you have a mortgage with HSBC, and we'll get onto this as well. We'll go into some of the more detail on this. When you have a mortgage with HSBC, do you own the property? Yes. When you take out a mortgage, and we'll get into this, the bank gives you the money, you go and buy the property. The property is in your name. Now, you own the property. What did we say just now? Can you rent something you already own? No. Do you take the risk in that property? If the property is destroyed and you've got a mortgage with HSBC, will the bank take the loss or will you take the loss? You will take the loss. This is inherently how you determine between rent and interest. Rent is when you are renting something you don't own and you don't take the risk in it. Okay? Interest is when you are paying money on a monetary debt. You might own the asset already, but you have borrowed money from the bank and you are paying interest on the money that you have borrowed. It's nothing to do with the property. Okay? So keep this principle in mind and it will become clearer as we go through some of the products. Risk sharing. Right, this is a really, really interesting one. How do you determine a true partnership in Islam? It comes down to risk. Okay? It comes down to a principle, al-kharaju bid-daman. The reward follows the risk. Okay? So, if you want to receive a return on your money in Islam, you have to be willing to take risk on your money. Why is it that when you put money in your bank account with HSBC and HSBC gives you interest on that money, why is that money haram? Because your money is not at risk. When you put money in a bank account, you're depositing money, you're actually lending money to the bank. This is what we don't realize. When we put money in a bank account, we're actually lending money to the bank. The interest they're paying us on the bank account is because we're lending them money, they're paying interest on the money that we have loaned to them. Now, is that money capital guaranteed? Yes. HSBC must give you your money when you demand it. If HSBC cannot give you your money when you demand it, the government will step in and make sure you get your money when you demand it. Okay, so your money is capital guaranteed. That means any return you receive on that money is riba, because you have not taken risk with your capital. And in Islam, Islam demands that if you want to receive a return, you must be willing to take risk. Al-kharaju bid-daman, the reward follows the risk. You cannot accept a return on your capital if you're not willing to take risk. Right, so now what defines a partnership? If I have loaned money to you and you have to pay me that money back no matter what, it doesn't matter if your house is destroyed, you still have to pay me that money. It doesn't matter if you lose your job, you still have to pay me that money. It doesn't matter if you die, your family still has to pay me that money. That is not a partnership, that is a debt. Okay, that is the definition of a debt. You owe that money no matter what, come what may. This is how a mortgage works. And we'll get onto this. What about this? Myself and Maulana Shams buy a car together. Okay? I haven't loaned any money to Maulana Shams. He hasn't loaned any money to me. We have both bought the car together. I own 50%, he owns 50%. If that car is destroyed, who takes the loss? Both of you. Bingo. Risk sharing. This is a partnership. If I have a contract with Maulana Shams saying, we've bought this car together, I haven't loaned you anything, you haven't loaned me anything. But if the car is destroyed, you must immediately buy my share of the car off of me. Imagine I said that to you. The car has been destroyed. Maulana Shams, now you have to buy my share of the car off of me. What will you say?
On your bike.
On your bike. What car? There is no car. Why am I going to buy something that doesn't exist anymore? That's not a partnership, is it? That is a debt. You owe me this money, come what may. Even if the asset is destroyed, you owe me this money. That is a debt. Okay?
Let's go Beshara Mall Brigade.
Right? So, the way to determine a true partnership in Islam, you have to look at, is there a debt? Do I owe this money no matter what? And is there risk sharing? If something happens, will the funder take the loss with me, or do I take all of the risk? Okay? So it comes down to risk sharing. Final principle to be aware of is the principle of having two contracts of sale in one. The Prophet ﷺ forbade having two contracts of sale in one. Why? Can anyone tell me why? Any guesses? Okay.
Basically, you can generate an arbitrage and remove the risk element.
Oh, perfect, mashallah. This brother knows his stuff. You have a financial background, I think, mashallah. The brother basically hit the nail on the head. And this is something that's done, unfortunately, in many financial institutions. And Sheikh Salman, he talks at this point about the fact that when he was a lawyer working for the Islamic finance department of a top law firm, his job was basically to replicate riba-based products by combining contracts of sale together. You can combine two contracts of sale to replicate any riba-based contract. Fact, right? I'll give you a very, very simple example, and I need to make sure I get this right. Okay. Maulana Shams comes to me. Sorry, I'm picking on you. Right. Maulana Shams comes to me and says, I need to borrow £100. Okay? Now, I can't give Maulana Shams £100 and say, okay, you have to give me the £100 back in a year's time and give me £10 on top of that. What would that be? That'd be interest, right? Because that's a debt. I'm not risking my capital. He owes me that money no matter what, and I'm charging him money on top of that. So I can't do that. But what I can do is I can say, okay, I have a lump of metal. I'm going to give you the lump of metal. And this lump of metal costs £110. You don't have to give me the £110 today. You can give me the £110 in a year's time. So far, so good. This is a beautiful contract. I'm giving Maulana Shams time to pay. Here, you have bought a lump of metal for me. You owe me £110, but take your time. Pay me in a year's time, no problem. Okay, so far, so good. Very beautiful contract. But I also stipulate that whilst you have bought this lump of metal from me, which you don't want nor need, you must immediately sell this lump of metal back to me for £100 on the spot. So I've given the lump of metal. He owes me £110 in a year's time. I've also put a second contract. You have to sell the lump of metal back to me immediately for £100 on the spot. I've got the lump of metal back. I've given Sheikh Shams £100. What have we achieved here? Sheikh Shams now has £100 in his hand. The lump of metal hasn't actually moved. It's irrelevant. And he owes me £110 in a year's time. What have we achieved? We've achieved the exact same outcome as an interest-bearing loan through two simple contracts, which in isolation, each of those is completely halal. The contract for Maulana Shams to sell me his lump of metal for £100 today, completely halal. The contract for me to give Maulana Shams a lump of metal and say, give me the money, £110 in a year's time, completely halal. Each of those contracts is completely halal. But when you combine them together, you replicate an interest-based loan. And this is why the Prophet ﷺ forbade explicitly the combining of two contracts of sale in one. And again, we'll get into some of that as we go through the products. So these are the three key principles you guys need to have. This is your baseline foundation understanding of the principles of Islamic finance. Rent versus riba, who takes the risk, who owns the asset. Risk should be shared. Is there a debt? Does the funder actually take risk? Does the funder actually take a loss? Or is it a true partnership? Two contracts of sale in one. Am I entering one contract of sale or am I entering two contracts of sale, and are they both obligatory? These are the three things, if you take nothing else away from today, these are the three things to be aware of. And again, as I mentioned towards the end, there'll be an opportunity to get a free ebook with covering some of these principles as well, inshallah. Okay, so now let's get into some of the actual products on the market. We're going to walk through from a layman's perspective how each of the products work and the things you need to be aware of. Product number one, conventional mortgage. We started talking about this already. How does a traditional mortgage work? And I encourage you, there's words on the screen, I encourage you to ignore the words. I'm going to walk you through it, inshallah. So with a traditional mortgage, as we've already discussed, you go to the bank, you say, I need to buy this house. I need £200,000. The bank will give you £200,000. You will take that money, you will go and buy the property. The property will become yours. Your name will be on the title deed. And you will now owe £200,000 to the bank. And you have to pay this £200,000 back as a fixed debt over a set period of time. And you have to pay interest on it along the way. Until you've paid it back, you have to pay interest. If anything happens to that property, the bank doesn't care. You still owe that money back. If you lose your job, the bank doesn't care. You still owe that money. You still owe those payments. If you pass away, the bank doesn't care. They will chase your family for those payments. Who here knows what the word mortgage means? Anyone know what the word mortgage means? I like telling this. The word mortgage comes from French and Latin. You will recognize the first half of the word, M-O-R-T, mort. What does mort mean? Death. The word mortgage means death grip or death pledge. Believe it or not, that's what the word mortgage means. They're selling this under people's noses. The word mortgage means death grip or death pledge because the bank has you in its grip until you die or until you pay off that loan. And even after you die, it takes the grip and holds it over your family instead. This is the word mortgage. Now you're starting to see why mortgages are not very well loved in Islam, right? So no matter what happens to the property, no matter what happens to you, you owe that money back with interest. This is a mortgage. Now, with a mortgage, your name is on the title deed. Does that mean the property belongs to you? Trick question. It doesn't. So legally, you are the owner of that property. But who has the first right over that property? Can you tell me? Precisely, the bank. So it doesn't matter whose name is on the title deed. It's irrelevant. It's a fiction. It's a fantasy. Yes, I own this house. It's my house. But guess what? You don't have first right to that house. The bank does. Now, if you do not pay that money back to the bank, what are they going to do? They're going to take the house. They're going to sell it. You have no choice in the matter. So you may own the property technically on title, but the bank has the first right and can do with it what they need to until they're happy to remove their death grip over you. This is a mortgage. Subhanallah. So there are some pros to mortgages and there are some cons. The pros, there's lots of providers. It's a very well-established product in the market. They're very heavily regulated. Why are mortgages so heavily regulated? Can anyone tell me? Why do mortgages need to be regulated by the Financial Conduct Authority? Because of riba? I don't think the Western government cares. Wa alaikum assalam wa rahmatullah. Exploitation. I love it, Maulana Shams. When you take out a mortgage, you are taking out a death grip, a lifelong pledge worth hundreds of thousands of pounds. If that is the wrong product for you, or if it is not managed correctly, do you think it might ruin your life? There's a very high possibility that if you are taking out a debt worth hundreds of thousands of pounds, that's going to last the majority of the rest of your life, and it's the wrong product for you or it's mismanaged, there's a very high probability it could ruin your life. This is why the Financial Conduct Authority heavily regulates mortgages, to make sure that banks and financial institutions are not ruining people's lives, okay? Because they have this huge debt to be aware of. Right, what are some of the cons? So yes, it's regulated. That's a positive, but why is it regulated? Because it's such a devious invention. Okay, what are some of the cons? Well, for us as Muslims, the obvious one, the fact that it's debt-based, there's no risk sharing. It means any money you pay on the mortgage loan is interest, is riba, and this is something we are very, very uncomfortable with as Muslims. There's very, very little flexibility with mortgages. So when you have a mortgage with Barclays and you're paying your monthly payment, which might be £1,000 per month, which is your interest plus your capital repayment, you get promoted. Is it likely over a 30-year period you might get promoted, you might earn a bit more money? It's quite likely at some point. So you've gotten promoted, you're earning more money, and you say, oh, actually, you know, I've got my money in my pocket, I can start paying £1,200 per month. Will the bank let you do that? Only on an interest-only mortgage. Very small flexibility, up to 10%. Up to 10%. So I very carefully chose £1,200 instead of £1,100 because that's more than 10%, right? But even then, can you just decide to change your payment to £1,200 forevermore? No. Okay. You might be able to make some one-off payments. If you make too much early payment, the bank will charge you a penalty, an early repayment penalty. Yep. And similarly, if your monthly payment is £1,000 and this month you've only got £800 in your pocket.
Why is that? Why do they do that?
Because they have a fixed debt and they want to make a certain amount of money off of you over a certain period of time. So that's why they give you very, very little flexibility.
They're committed to the market.
match their assets and their financing, right? So their
Correct.
liability match.
Correct. There's a reason. There's a reason. A very, very good point. There's a reason banks offer debt-based funding. It's because they have to match their assets and their liabilities. So what is their liability? It's the deposits people have in their accounts. If people are effectively lending money to the bank through their bank accounts, the only way the bank can use that money to fund mortgages is if they're lending that money out to match the liability, right? They can't take a debt-based liability and match it with an equity-based asset. It doesn't work. So this is why banks must offer debt-based funding. But on the flip side, so forget being promoted. What about the opposite, where you've only got £800 in your pocket and you can't afford the £1,000 payment? What will happen? Yes, they're going to ask for the 1,000 anyway. And what if you can't pay the 1,000? They'll charge penalties. They will give you a little bit of time to pay, but the £200 shortfall, they're going to charge interest on that until you've paid it off. And generally, they might give you a couple of months to make good on that shortfall. Some might give you 3 or 4 months. And after that, what are they going to do? If you still can't pay it, what are they going to do? Repossess the home. They're going to take your home away from you. They're going to sell it, and they're going to take first dibs on the proceeds to pay whatever they are owed. You get whatever's left over, even though it's your home. They have first rights. Okay. And as we've already touched upon, you get charged penalty fees for early and late repayment if you go above a certain amount. Okay, who are some of the providers? You already know them. Barclays, HSBC, Lloyds, the big high street banks. You've got high street building societies like Halifax, Nationwide, and you've also got some specialist mortgage lenders like Click Mortgages. Ownership profile, this is a really interesting one. So with a bank mortgage, your ownership profile is 100% from day one. On the land registry, on the title deed, it's your name, just your name, nobody else's. 100% ownership on day one, all the way through to the end. But as we've discussed, that ownership is a bit of a fiction, because actually the bank, even though their name isn't on the title deed, technically the bank is a 0% owner. But despite that, they have the first right to your property. Okay, that's a traditional mortgage. I don't want to spend too long on that. I want to spend a bit more time now on an Islamic bank mortgage. So what's the difference between a conventional mortgage and an Islamic bank mortgage? I feel like sometimes I'm holding this too close. Can everyone hear me all right? Okay, all right. So with an Islamic bank mortgage, as we've discovered, if you go to the Islamic bank and say, I'd like to buy a home, they can't say, okay, here's the money, take the money, pay us interest on the loan, because that's quite clearly riba, quite clearly not permitted in Islam. So what the Islamic bank does is slightly different. The Islamic bank, rather than giving you the money for you to go and buy the home, the Islamic bank will buy the home themselves. So you'll identify the property, they will buy that property, okay? And what they will say is, okay, you've contributed to this £100,000 home, you've contributed £10,000, we've contributed £90,000. Now, you must buy the property off of us today on the spot. So we're going to sell the property to you today for £90,000. But you can pay that £90,000 off over time, okay? Over 25 years. You don't have to pay it all today. You can pay the £90,000 over the next 25 years. But on top of that, you must also pay rent on our share for the entire duration. So what is the rule? There were 3 rules I came up with earlier. What is the rule that this potentially contravenes off the bat? So you must buy our share of the property off of us for a fixed price over a fixed period of time. And as well as that, you must rent the property off of us as well for that period of time. 2 contracts of sale in one. One is the sale of the ownership of the property. You must buy the property off of us over a set period of time for a fixed price. One is the sale of the usufruct of the property, or the use of the property, either rent. Giving you the ability to live in the property and rent it. So we've got 2 contracts of sale in one here. Now, what are we achieving here? You owe the bank a fixed sum of money over a fixed period of time, correct? Because you must buy that property off of them for a fixed price over a fixed period of time. So you must pay the bank a fixed sum of money over a fixed period of time, correct? On top of that, you must also pay money on top of that debt. What is this starting to look a bit like? Okay, now I'm not here to say it is, and I want to caveat that there are reputable shayukh who have approved these contracts. But I'm here to highlight some of the gray areas, some of the areas of difference. Okay, so you can see that one of the problematic areas with Islamic bank mortgages, and there are others which I'll cover, one of the problematic areas is having potentially 2 contracts of sale in one, which is strictly forbidden in Islam. Why? Can anyone remind me? Why is 2 contracts of sale forbidden in Islam?
Mimic debt.
You can mimic interest-based debt. You can mimic interest-based debt by combining 2 contracts of sale in one. Okay. Now, the other thing is, when you are paying rent to the bank, how does the bank set that rent? They set it based on the Bank of England interest rate. So the rent you have to pay on our share is the Bank of England interest rate, and it will vary in line with the Bank of England interest rate. So you've got 2 contracts of sale that are starting to look a bit like a debt with interest, and the rent you're paying on the contract that looks a bit like debt with interest, the rent is benchmarked against interest. So it's starting to smell and look a bit fishy. Okay. Finally, if anything should happen to that property, you recall I mentioned buying the car with Maulana Shams and saying, if the car is destroyed, Maulana, you must buy my share of the car off of me. And Brother Nasser said, on your bike, right? So there will be a contract in Islamic bank mortgages stipulating that if anything should happen to that property, if the property is destroyed, you must immediately buy the bank's share of the property from them. What was the fundamental principle we talked about, which this contravenes? Risk sharing. Fantastic. You guys are a great audience, mashallah. So look, these are some of the areas of contention with Islamic bank mortgages. We also need to be fair and understand that Islamic bank mortgages have been approved by reputable Sharia scholars. There is difference of opinion amongst the Sharia scholars. Some Sharia scholars are vehemently against Islamic bank mortgages. Our own Sharia scholar, Sheikh Salman, my co-founder, he does not agree with them. And our external Sharia scholar, Sheikh Haytham al-Haddad, also does not agree with them. But there are also reputable scholars who are comfortable with them, scholars who we respect, scholars who Sheikh Salman respects, some of them are his teachers. And it is okay in Islam to have difference of scholarly opinion. It is okay for scholars to disagree with each other. And we must understand that this is a mercy that Allah has given us. If 2 Sharia scholars who are well qualified and well intentioned tell you 2 polar opposite things, which one is correct? Both, precisely. This is a mercy, this is a rahmah in Islam, and we need to understand this. Okay. The scholars who do approve these Islamic bank mortgages, are they 100% satisfied with them? Do they believe they are the perfect product? No. Most of them will be the first to tell you, this is not the perfect product. There are things that need to improve. But why do they approve them? Why are they satisfied with them? Generally for one of 2 reasons. Some scholars are just genuinely satisfied with them. They say, okay, it's not perfect, but it is enough. There is another type of scholar who approves them because they say, and this is very fundamentally important, brothers and sisters, Muslims need to buy homes. Very important. If you are a family, and Sheikh Salman talks about some of his experiences where he knows people, he's got friends and family, and I'm sure there'll be people in this room, where you have 2 baligh children, a boy and a girl, sharing a room together, and you only have a 2-room flat and you have 4 children maybe, and you've got baligh children sharing a room together, and you cannot give dignity to your children, right? You need a home. Now, if the Sharia scholars say to you, no, nothing is halal, you cannot buy a home, it's going to create a real problem for Muslims. And so there are also Sharia scholars who approve them on the basis that it is the lesser of the evils. We need a way for Muslims to buy homes. We need to gradually improve and create better products that are more and more tayyib, more and more pure and halal, which is what FIDA is trying to achieve, inshallah. But in the meantime, until we get to that point, it would be futile and wrong to turn Muslims away from buying homes, because that is the greater evil. Muslims not having homes, Muslim wealth declining, Muslim mental health issues coming, all of this has been shown to occur from a lack of home ownership. And so it's very, very important that Muslims have homes and that Muslim wealth increases and that we have stability in our families and our households. So this is also important. Okay, so to summarize, some of the benefits of Islamic bank mortgages.
I think that they're just going to add that one of the arguments is that it's a structural need. You know, economic establishment is important within the Muslim community, and it's the idea that one is a situation in a society where all of the Muslims don't own anything, right? They don't own any property, is not sustainable and is structurally unsound. And also a situation in which Muslims in a society have no legacy, right? They leave behind no wealth of substance, is also structurally unsound. It's a problem. It's essentially creating an economic calamity at the collective level. Yeah. And that's a big issue. Yeah. I think Sheikh Qaradawi makes this argument. I think it's really important to recognize it.
Yeah, absolutely. Okay, so to summarize Islamic bank mortgages, what are some of the benefits of Islamic bank mortgages? As mentioned, they are approved by reputable Sharia scholars. They do still charge early and late. Oh, Jazakallah khair, Sheikh. Thank you so much.
Wasn't a day when I could stay.
No problem at all, inshallah. Jazakallah khair. Assalamu alaikum. Okay, whilst Islamic banks do still charge early and late repayment fees, they donate them to charity, so they don't keep them for themselves. And they're also regulated and well established. And the reason, again, they are regulated is why? What did we say earlier? Why are conventional bank mortgages regulated? Prevent exploitation, lifelong debt, death grip, right? All of these things which could potentially ruin people's lives. So Islamic bank mortgages are also debt-based products. They also have that similar kind of transactional outcome, and therefore it's very, very important that they are sold in the right way and they are managed in the right way, and that's why they're very, very heavily regulated as well. What are some of the cons of Islamic bank mortgages? Well, they are still ultimately debt-based products. And as I mentioned earlier, in Islam, when dealing with financial contracts, unless you have a qadda hasana, a beautiful loan where there is nothing to pay on top, Islam very heavily sways towards partnership rather than debt. The problem with debt is anything you pay on top of a debt generally can become riba. There is no material risk sharing with Islamic bank mortgages, unfortunately. As I mentioned, there will be a clause stipulating if the property is destroyed, you must immediately buy that share of the property from the bank. And the rent is unfortunately benchmarked to interest rates. So it looks and behaves very, very similarly to a conventional mortgage, again with the caveat that they are also approved by reputable Sharia scholars. Some of the current providers, Al Rayan Bank is the largest Islamic bank in the UK. Actually, they have now stopped recently offering Islamic home finance except to high net worths. Gatehouse Bank also do Islamic bank mortgages, and then you've got some smaller providers like UBL and Ahli United as well. There's also, for this type of product, they're not a bank, but Offer is entering the market soon with their regulated home purchase plan. And you've also got providers like Stride Up out there as well. Ownership profile, this is very interesting. So who remembers what the ownership profile for a conventional bank looked like? 100% from day one, great. With the Islamic bank mortgage, it's the other way around. The bank owns 100% of the property on day one. And as you make your payments, that ownership doesn't change until the very last payment. Once you've made your very last payment, then the ownership of the property will transfer to you 100%. Okay. Now, interestingly, here, your name isn't on the title deed like it is with a conventional mortgage, but your rights are identical, right? No difference. So whether your name is on the title deed or not actually doesn't matter until you have paid off the mortgage or the finance. It only matters after that point. During the term of the finance, whether you've got a conventional bank mortgage or an Islamic bank mortgage, it actually is irrelevant whose name is on the title deed. Your rights and the bank's rights are identical. Okay, that's an Islamic bank mortgage. I now want to touch upon a slightly newer type of ownership product, which is called shared ownership, or sometimes known as co-ownership. Now, with a shared ownership product, this is really interesting because from a Sharia perspective, the product structuring, very halal. You cannot deny it. How does it work? The shared ownership provider will buy that property with you in partnership. You both own the property together. They didn't lend you any money, you didn't lend them any money. So you now part own the property. You now part rent the property. So you are living in that property, you have exclusive right to enjoy that property, so it's fair that you pay rent on the share that you do not own. Okay? Your only obligation is to pay rent. That's your contract of sale, your rental contract. There is no obligation on you to buy out the share ownership provider. So there is not this issue of second contract of sale. You do not have to buy them out if you don't want to. You can continue part owning and part renting for as long as you like. You may be able to buy out the shared ownership provider. And what most shared ownership providers will do is they will give you a window during the year. Some might give you one window in a year, some might give you 2 windows in a year, where you can approach them and say, I would like to buy more shares in my property. And it's up to you to remember to approach them in that window. They will not remind you. But if you do, you can go and offer to buy more of their share from them. Right. This is a second contract of sale, buying more equity from them. Is this breaching the issue of having 2 contracts of sale in one? No. Great. You guys are fantastic, mashallah. Why not? You still have your rental contract, you still have to pay your rent, and you've now entered a second contract to buy a share of equity from them. That is 2 sales of contract, 2 contracts of sale. Why is it not breaching the principle of having 2 contracts of sale in one? You got the answer right. Who can tell me why?
There is no obligation.
Fantastic. Brother, you are my favorite person in this audience. You are answering all of my questions, mashallah. Actually, I love you all, mashallah. Excellent. There is no obligation. When you're renting a property from a landlord, your only obligation is to pay your rent and take reasonable care of that property, correct? Can you go to your landlord anytime and say, Mr. Landlord, I want to buy your property from you? You can offer. They don't have to accept, but you can offer to. It's entirely fine. Is that haram? No, of course not. Anyone can go and offer to buy the landlord's property from them. He is at liberty to say yes or no, but anyone can offer. The reason this doesn't breach the prohibition is because the 2 contracts are completely isolated and independent from each other. There is nothing saying you must buy the property from the landlord. It is up to you, offer and acceptance on the spot, completely unrelated to your rental contract. And that's why there is nothing wrong with this whatsoever. So just like you can approach your landlord anytime and offer to buy his property from him, similarly with a shared ownership provider, they'll give you opportunities during the year, no obligation, where you are allowed to go and approach them to buy more equity. And this is a very, very halal contract. The rent that they set is not benchmarked against interest rates. It is generally based on market rent. And if anything should happen to that property, you don't owe them anything. They will take the loss with you. So there's no contravention of any of those 3 principles that we talked about earlier on. Very, very beautiful Islamic contract, mashallah.
What about missed payments?
Fantastic. I was just about to come on to it, actually. Missed payments. So from a Sharia perspective, the product itself, completely halal. But there are practical elements that you need to be very cognizant of. And all I mean by this is you need to understand the contract you're getting into. So I'll come on to it, inshallah. When you are considering buying a shared ownership product, and there are providers out there like Your Home and Way Home, FIDA's product also comes under the shared ownership category. When you're considering buying a shared ownership product, it's very important, if there's 2 things you take away from this talk. One is the 3 key principles I talked about. 2 is this point here. It's very important when buying a home, whether through shared ownership or actually through any product, that you put your solicitor through their paces. Make your solicitor work hard for you. Make them tell you what you're getting into. Make them explain every single detail of the contract to you. Because conveyancing solicitors, Allah bless them, are there any conveyancing solicitors in the room today? No, good. Now I can talk negatively about them. Conveyancing solicitors, they tend to be very busy. And as a result, if you're not asking them and pushing them, generally in my experience, they'll do the least amount of work possible because they've got a lot of clients to deal with. So if you're not pushing them, they will assume you're happy and they'll just push the deal through. Whereas you, as a consumer, need to understand the contract you're getting into. Why have I brought this up only now on shared ownership? Because with mortgages, bank and conventional mortgages, generally the contract is fairly well understood. With shared ownership providers, the contract can vary greatly, right? It's not so standardized. There are some, and I'm not going to name any names, it's up to you to do your own research. There are some shared ownership providers who will have a clause in their contract saying that if you miss 1 payment, they have the right to take the property away from you and give you absolutely nothing, right? Very, very penal. And this is something you need to understand before getting into this contract. So, some of the pros of shared ownership providers: debt-free, no debt, truly partnership-based, risk sharing, generally easier to purchase than with a bank. The entry criteria is lower. What do I mean by that? The affordability checks are a bit easier to pass. Why are they easier to pass? Can anyone tell me? Can anyone guess? Why is it easier to pass the affordability check with a shared ownership provider compared to with a mortgage?
Because they've got a little less risk, isn't it? They can just take it.
No, they take more risk. They're sharing the risk in the property with you. But that's not what it is.
They are in the rental business.
Rental. Mashallah, this brother is on fire. Okay, with a bank, they are assessing your ability to pay what? Your interest plus your capital repayments every single month, which might be £1,000. With a shared ownership provider, what are they assessing?
Rental.
Just your ability to pay your rent. They don't care about your ability to buy equity and staircase up. They only care about your ability to pay your rent. Now, if you're only paying your rent and not buying equity on top, that's a smaller amount than the interest plus capital or the rent plus acquisition with the Islamic bank mortgage. So the test is an easier test to pass. You get some providers out there, I think Wayhome does this, don't quote me on this, do your own research, where they will say you can buy a property worth 20 times your annual income. What multiplier will a bank normally give? Anyone know? 5 times, 4.5 to 5 times, great. So with a shared ownership provider, you might be able to buy a property 20 times your income. Why? Because they're only assessing your ability to pay your rent. If all of your money is going towards paying your rent, are you going to be able to get to full home ownership? You're not going to have any money left over to buy equity. That's the first issue. The other thing is, with shared ownership providers, hands up, who knows, if you were to buy your home all the way to 100% with a shared ownership provider, who knows how that will compare in cost to a mortgage? More, less, the same? Any idea?
Probably more.
Probably more. Why?
Can only buy 10%.
That's part of it. Wayhome only let you buy 5% in a year. Yep. Okay. But also, what happens?
For the property, isn't it? You're paying for the rent.
You're paying rent. But what happens when you go to them and say, I would like to buy your share of the property from you? I'd like to buy more. I currently own 10%. I'd like to buy another 10%. What will happen at that point? Perfect. MashaAllah. You're my second favorite person in the room, MashaAllah. The shared ownership provider will say, okay, you want to buy another 10% from us? Great. We have to get the property valued. So you have to pay for another valuation. And what do you think is going to have happened? Generally speaking, in the UK, which direction do property prices move? Up. By how much per annum on average? 3%. Any other guesses? 5 to 10%. On average, property prices in the UK go up 5 to 10% per annum. How much do wages increase by?
0.
Or negative if you're a nurse, right? Long-term wage inflation, who can tell me? MashaAllah, this brother's earning very good wage inflation. 3 to 5 is top end. You, MashaAllah, work for a professional services firm, I can tell. Anyone else? Any other guesses? Long-term wage inflation in the UK? 2 to 3, still high. Minus if you're a nurse, 1 to 2% per annum. Long-term wage inflation in the UK, 1 to 2% per annum. Long-term property price inflation in the UK, 5 to 10% per annum. If the cost of buying equity from your shared ownership provider is going up 5 to 10% every year, but your wages are only going up 1 to 2% every year, is that property going to become unaffordable over time? Are you ever going to be able to get to full home ownership? Very unlikely. This is the biggest downside to be aware of with a shared ownership property. Generally, within 5 to 7 years, it becomes unaffordable to continue buying that property unless you're in the top 1% of earners. Okay, so most shared ownership providers will not position themselves as an alternative to a mortgage because they know the chances of you getting to full home ownership are very slim. Most shared ownership providers will position themselves as a stepping stone onto a mortgage because the affordability criteria is lower, lets you get into your home, prove your track record of paying your rental payments, and that helps you then get onto a mortgage later. So with Wayhome, for example, they generally expect their customers within 5 to 7 years to remortgage away from them. That is their business model. Your home will probably be very, very similar to that. And so if you are considering taking out a shared ownership product, the key things to be aware of are what are the key terms in the contract you need to be aware of. Push your solicitor hard, make sure you understand. What is your longer term game plan? How are you going to fully own this property? Are you expecting to get to full home ownership just with this provider? Or do you expect to switch within 5 to 7 years? Or are you a top 1% earner where you can just afford it? You need to understand your longer term game plan. Too often we see everyday people entering these long-term contracts and they just think about what is it costing me today? Khalas, let's go for it. That is not good enough when you're entering a potentially lifelong commitment. You need to be thinking about the future. You need to thinking about what are you going to be earning in the long term, and is this affordable to you in the long term? And if not, what is your alternative strategy? Okay, this is very important when considering a shared ownership product. And the other thing to think about is if you have windows in which you can buy equity, you need to set your reminders because they will not remind you. If you miss your window, you miss your opportunity. You'll have to wait for the next window. Ownership profile. The bars are a little bit messed up here, apologies, but what this is trying to say is on day one, maybe you own 20% and they own 80%. And unless you remember to actively go and buy more equity from them, that equity profile will not change. Your ownership profile will stay the same throughout the term of the contract because there is nothing in the contract for you to actually buy more. It's up to you to go and offer to buy more during those windows. Okay, I've discussed enough about shared ownership, I think. Key things to be aware of I've discussed. So I'm going to also talk a bit about the Pfida product. The Pfida product also falls into the shared ownership category or co-ownership category. It's a true partnership. There's no debt. We don't lend any money. You don't owe us a set price over a set period of time. We buy that property with you as partners. You rent the share that you don't own, just like with a shared ownership provider. You have the opportunity to buy more equity from us, but rather than giving you a window once or twice a year, we give you an app. I think I'll talk about our app. Yeah, okay, I'll talk about our app. We give you the opportunity to basically pay what you want every single month. You can choose what your payments are month on month. So we give you enormous flexibility. True risk sharing. If anything happens to a property, we're your partner. We take the risk, we take the loss with you. No debt. So you don't have to buy us out over any period of time. You can rent our share for the rest of your life if you like. We've gone through great lengths to make the product more affordable than other shared ownership providers. And we are a shared ownership provider, not a bank provider, remember this. So we've gone through great lengths to make sure that even though we are offering a shared ownership product, shared ownership products tend to be significantly more expensive than mortgages. We've gone through great lengths to make it competitively priced, even against a mortgage, even though it is not a mortgage and even though we are not a banking provider. How do we do that? By being as generous as we possibly can. When building the business, I made the decision early on that we will make our money off of the rental income that we generate. All of the upside in the capital, in the property value, as the property grows in value, I decided that we will gift that to you guys, to our customers, because our mission and our vision at Pfida is to increase home ownership and wealth, particularly amongst Muslims. And the way to do that is to make home ownership affordable. So when you are buying our share of the property from us, we don't revalue it. We sell it to you at whatever we bought it. If the property is doubled in value, that is our gift to you. We make our money off of the rental income and we are satisfied with this, alhamdulillah. There's also something very unique about our product, which makes it more secure than other products on the market. And this is the notion of what we call an equity buffer. So as we mentioned with a mortgage product, let's say your monthly payment is £1,000, and let's say that comprises £500 interest and £500 capital repayment. You've only got £800 in your pocket this month, you're in default. The bank might give you a couple of months payment holiday to make good on that. They might charge you interest on that in the meantime. And within a couple of months, they might repossess your property. With the Pfida product, you have actual equity in that property on day one. And we actually give you share certificates proving your equity ownership. Now, if you fall into hard times, Allah protect every single one of you, you've only got £800 in your pocket. Well, your target monthly payment might still be £1,000 because you might come to us and say, I'd like to fully own my home after 25 years. And we'll say, okay, to achieve your goal, here's how much of our share you would need to purchase from us every month. And if you stick to this, by the end of 25 years, you will have bought all of our shares from us and you'll be the full owner of that property. But that is just maths. It's just a target to help you visualize your goal. You don't have to stick to it. You can go higher, lower, throw it out the window and just pay rent. It's entirely up to you. The equity purchase bit with our product is completely optional, completely flexible. So what this means is even though your target payment may be £1,000 per month, which is maybe £500 rent and £500 target equity purchase, if you've only got £800 in your pocket, no problem at all, just pay £800. You've still paid your £500 rent, and in that month, instead of buying £500 of equity, you've just bought £300 of equity, no problem at all. This is completely flexible how much equity you want to purchase, if at all. Now let's see what happens if you can't even afford to pay your rent. Well, this is where you can dip into what we call your equity buffer. So on day one, you will contribute a sum towards the property and we will contribute a sum towards the property. Typically, we recommend you contribute 20%. And that is so that you have a high stake in the property. Your rent will reduce by 20%. That will make it easier for you to buy more equity over time because you've got 20% less rent to pay. We accept 15%. On a very rare case-by-case basis, we'll consider 10%. But generally, 15% and up is what we encourage. Now, if a customer loses their job on day one without ever having made a payment, and they've got 10% equity in that home, our average customer dipping into their equity buffer, what I mean by this is using their equity to pay their rent, right? So you've got 10% equity in the home. Instead of paying us £500 cash, you pay us £500 from your equity. As far as we're concerned, you've paid your rent. This is not a default with us, right? An average customer with 10% equity who lost their job on day one without ever having made a payment, if they had 10% equity, that 10% equity buffer would last our average customer around 2 to 4 years. That's 2 to 4 years of security when you're going through the hardest time of your life. Rather than the banking model, where you're down on your knees, you've just lost your job, and the bank comes and takes your home away from you. With the Pfida product, when you're going through that time, may none of you ever go through that time, instead of thinking, oh my God, how am I going to pay the mortgage? You have the comfort knowing that you've got the security of the roof over your head because you've got your equity buffer, so you can focus on what's important, getting back on your feet, finding another job, and starting to make your payments again. And this is fully aligned with the Sharia etiquette of helping your fellow Muslim when they're going through difficulty, rather than the bank coming and taking their home away from them as well, which we think should be illegal. So these are the key features of the Pfida product. I also want to just quickly talk about our tech. So we've got a web app that all of our home buyers get access to, and this is, I think, a really, really beautiful feature of our product. So when you buy a home with us, you can log into your web app, you can log into your dashboard, and in your dashboard, you see all the metrics to do with your agreement. You can see your monthly payments and how they break down between rent and target equity purchase. You can see your lifetime projections. You can see various pie charts and bar charts, everything you need to know to understand your agreement with us. You can then do what we call payment management. So you can go into your web app, literally month to month, say, this month I just want to pay my rent, click done. This month I want to pay my rent and buy my target level of equity purchase, tick done. This month I've been promoted. Instead of £1,000 per month, I can afford to pay £1,200 per month. You can go into the web app and say, right, going forward, I'm going to start paying £1,200 per month or £800 per month, click done. And we actually had an example of this. We've got, mashallah, people from all walks of life who have bought homes with us. Malana Shams is one of them. But we've got a customer, self-employed taxi driver, and he fell into some ill health, right? And he couldn't work for a while. He couldn't earn money for a while. Now, with a bank mortgage, he would have had to call up the bank and beg for mercy in a very embarrassing way. What did he do with us? He went into his web app. He reduced his payment to something he could still afford to pay. And he sent us a message saying, just so you know, I've fallen into some ill health. I can't work for a while. I've reduced my payment to X. When I'm working again, I'm going to increase it again. So when going through a very difficult period, rather than calling up the bank and begging for mercy, he was able to live in a completely dignified way. He just sent us a message so we were aware, and that was it. He was able to carry on his daily life. And this is the beauty of the app that we have created. It lets you flex your payments according to your needs from month to month. You can also do what we call what-if analysis. So this is where, let's say you've come into some money, an uncle's passed away and left you £10,000. You can go into the app and say, right, what if I buy £10,000 of equity this month? What does it do to my term? What does it do to my monthlies? What does it do to my total cost? How much money do I save overall? Do I like this outcome? How about instead of buying £10,000 this month, I spread that over the next 3 months? What does that look like? Which version do I like more? Which one helps me achieve my goals? This one? Okay, click done. So, whereas with a conventional bank mortgage, you would have to, if you wanted to change your payments to £1,200 per month, you wouldn't be able to do it. You would actually have to go and apply for a brand new product. So you'd have to go through the time, the headache, the cost, the commitment of applying for another mortgage. And for those of us who drive here, we know the headache of renewing our car insurance once a year. Imagine renewing your mortgage, right? So you have to go through all of that, and you don't even have the information to know if you're making a good decision until you've gone through that process, right? Whereas with Pfida, you go into your web app, you check the app. If I change my payment to this, what does it do? Do I like the outcome? Click done. You can do it at 3 o'clock morning, sitting on your couch at home. You don't even have to call us. Forget applying for a brand new product, right? This is the beauty of the debt-free nature of this product. It only works because there is no debt. It only works because we allow you to buy more or less equity whenever you like, with no obligation. So we're really, really proud of this web app feature that we've created for you guys. Okay, so just to wrap up, quick comparison of the different products we've covered today, and then I think we're straight into Q&A. Yeah, then we're straight into Q&A after that, inshallah. So we've got the Pfida product on the left there. We've got the conventional bank mortgage, the Islamic bank mortgage, and the shared ownership product. The Pfida structure is a co-ownership structure, just like shared ownerships. Bank structures are generally mortgages. The Pfida structure, because it's a co-ownership or a shared ownership product, it's debt-free. There is no obligation to buy our share out over any period of time. Similarly to co-ownership providers, completely debt-free. Mortgage products, conventional and Islamic, tend to be debt-based structures. Our product, we have gone through great pains to make it affordable and competitive, even against banking products, despite the fact that we are not a banking provider, we are not a mortgage provider, we are actually a shared ownership provider. So you get all of the benefits of a shared ownership product, but we've tried our very hardest to make it affordable and competitive, even against a mortgage product. And shared ownership products, as I mentioned, tend to be very expensive longer term. Beyond 5 to 7 years, they become pretty much unaffordable, and the expectation is you will remortgage away at that point. With our product, you get to full home ownership at term because we give you your target payment profile. And by the way, you can go into the app and change your target payment anytime. We incentivize you to stick to your target payment as well. So if you say, I want to fully own my home after 25 years, we'll say, okay, to achieve that, you need to pay £1,000 per month. Whenever you stick to your target payment, we give you a rental discount, right? And that rental discount can be quite significant. It's typically at least 5 to 10%. It can be as high as 30% in some cases. It will vary by location heavily. But the point being, whenever you stick to your target payment, you get a hefty rental discount, and that's your incentive to get to full home ownership, because we want you to get to full home ownership. That's why we exist. So you get to full home ownership at term with the Pfida product, just like you would with a bank mortgage. With a co-ownership product, a typical shared ownership provider, you would not, because there is nothing incentivizing you or helping you to buy more equity. It's entirely up to you to remember to go and buy that equity during the set windows that you have. Our product has this equity buffer feature, which I think is very, very beautiful, which is there to protect our customers in times of difficulty and need. You have enormous flexibility with the Pfida product because, as I mentioned, you can go into the web app, literally change what you want to pay from month to month. You have absolute flexibility. Banking products, generally very, very little flexibility. As a brother here rightly mentioned, you might be able to overpay a little bit, but certainly not by too much, and certainly not on a continuous basis. Shared ownership products, generally more flexible than banking products, but you only have the set windows in which you can buy equity if you wish to. And if you're not ready to buy equity in that window, then you've lost your opportunity. Now, these next two are quite interesting. So Sharia compliance. So Conventional bank mortgages, goes without saying, are not Sharia compliant. Shared ownership products I mentioned are undeniably, the product is undeniably halal and Sharia compliant, no question about it. Islamic bank mortgages are approved by reputable Sharia scholars, as is the FIDA product. But where it gets more interesting is the next line, the maqasid of Sharia, the higher principles of Sharia, actually not just ticking the boxes of Sharia, but achieving the higher aims of Sharia. And this is obviously very subjective, I feel that the FIDA product is actually the only product on the market that is going above and beyond just ticking the boxes of Sharia and actually meeting the higher principles, the maqasid of Sharia, actually looking at, how can we help our customers? How can we be generous to our customers? How can we achieve the spirit of the Sharia, not just structure in a fancy way to tick the boxes of Sharia? Islamic conventional bank mortgages, obviously not. Islamic bank mortgages, the reason I've put no is because of the clear grey areas that we discussed earlier and the clear differences of opinion amongst the Sharia scholars. The reason there is difference of opinion amongst the Sharia scholars is because some Sharia scholars say, whilst they are structured to be Sharia compliant, they do not really adhere to the spirit of the Sharia because they are effectively replicating the same outcome and profile of interest-bearing mortgages. Shared ownership providers, the only reason I've put a cross here is because, first of all, they are extortionately expensive in the long run. So it really isn't designed to get you to full home ownership. It's designed to make money off of you before you then go and get a mortgage. But also some of them, as I mentioned, have very, very strict penalties if you miss even one payment. So whilst the product itself is halal, there are practical considerations to be aware of. Also to be aware of with shared ownership providers, whilst the product itself is halal, some of them are funded by interest-based debt in the background. So some shared ownership providers will just have a Barclays Bank loan in the background, funding them to fund their homes with. And again, this is a reason why I've put a cross here, because with FIDA, we're very, very proud that as well as being internally approved by Sheikh Salman, we have an external Sharia body, the Islamic Council of Europe, headed by Sheikh Haitham al-Haddad, who approve FIDA end to end, not just our home buying product, but also our whole business model and how we raise capital. And we are approved end to end. So this is why I feel the FIDA product is the only one really meeting the higher principles and aims of Sharia. Okay, what are some of the downsides to be aware of? Well, FIDA is not a regulated product, and I have to explain this here. Shared ownership products also do not need a regulatory license. Now, does that mean we are not under regulatory scrutiny? No, absolutely not. We still have to adhere to all of the regulations and laws around financial promotions and marketing. We are still in touch with the FCA on an annual basis where they review everything we're doing and get comfortable. But the product itself does not need a specific regulatory license. Banking products need a regulatory license because they are debt-based products. And we discussed earlier, when you're taking a debt-based product worth hundreds of thousands of pounds, if it's not correct, if it's not right for you, it can ruin your life. Whereas when you're renting a property from a landlord, if that product's not right for you, you can stop, change, move on anytime you like. You don't have any debt. It's not going to ruin your life. That's why the FCA doesn't need a specific license for these products. The other key downside to be aware of with the FIDA product is that we are one of the smaller providers in the market. We are not a bank. We are not bank funded. We are community funded. And what I mean by that is we also offer savings accounts, which I'm not, I don't have any slides on that today. But effectively, we offer savings accounts. The savings account money is what we use to fund homes. We are entirely community funded. We are a community-based organization. So we do not have the same level of resources as the banks. We are not able to serve people immediately. We have a waiting list and we have a lot of demand. If you want to find out a bit more about the waiting list and also indeed about our savings products and also how you can get ahead on the waiting list, all of that's on our website and you can visit our website and find out more, inshallah. I should also note that right now when you enter our website, before it even lets you enter, there's a big scary pop-up asking what type of investor you are. And that's because we offer investment products on our website. That banner, if you enter the website today, will be there. Give it a week or so, it's going to move to be just on the investment pages, inshallah. So please just bear with us while we get that moved. But in the meantime, you can inshallah work around it if you need to. So the big thing to be aware of with us, if you are looking at the FIDA product and saying, oh, this is something I'd be interested in, there is a waiting list to be aware of. And as I say, there's more details on our website. There are ways to get ahead on that waiting list based on our savings products, and you can find that all out on our website, inshallah. As I said, I wanted to try and strike the balance today between providing a truly educational session and not just talking about FIDA. Of course, I love FIDA. FIDA is my heart and soul. But I really wanted this to be an educational session for you guys, inshallah, rather than just pushing all of FIDA services. Right, okay. So I promised you guys at the start, if you stick around to the end, you can also have a free Islamic finance ebook. It's a 27-page ebook that we've written for you guys, covers a lot of the principles that we've covered today. Scan that QR code and you can download that absolutely free, inshallah. And I think it's about a 20-minute read. It's quite comprehensive. And inshallah, one thing we're really keen on, as well as doing events like this. Why do we do events like this? Because we feel education is important, especially Islamic finance education. A lot of people don't have the first clue about how Islamic financial products work. So we love doing community events like this, and we love providing educational material. So if you go onto our website, if you go into the knowledge section, there's a whole blog area where you can download other free brochures as well. And there's stuff on there around stamp duty, land tax, and stuff like that. So do check out the Knowledge Hub, and inshallah, we're continuously looking at additional educational content that we can provide as well. Okay, I think I took a little bit longer than I had originally planned. Apologies for that, and thank you all so much for bearing with me. What I'd now like to do is invite questions from the audience. I'm sure, no doubt, you have questions. We've covered a lot of content in a relatively short period of time.
A couple of simple ones. What's the average waiting time?
Average waiting time, the brother has asked. Really good question. So there are two ways of buying a home with FIDA. You can get onto the normal waiting list, what we call the public waiting list. You just go onto the website, register your interest, and you're going to get onto the public waiting list. You don't have to do anything else. That is a very, very long waiting list. We have a huge amount of interest. And we estimate that's a 5-year wait at the moment because we are one of the smaller providers on the market. There are ways to get ahead. And I have to be very careful because it involves investing and I can't promote investments. So you have to go onto the website and find out about that yourself. But there are ways to get ahead on that waiting list. Even then, about the quickest that we can possibly do is about 9 months. So you have to bear with us. We're relatively small. We can't move as quick. We don't have the same level of resources as the big banks, unfortunately.
On your point, thank you for a fantastic talk. In terms of your funding, in a hypothetical scenario for such a fantastic service that you provide, if you go under, what happens?
Great question. And we get asked this a lot, and it's a very, very valid point. Okay, the way our funding model works is we offer investment products. So banks have two key functions, right? You've got your deposit account and you've got your mortgage lending arm. We operate a bit like a building society, a bit like a new age building society. So we have savings accounts, and those are investment-based savings accounts. And we use the proceeds of those investments to fund homes. So people who open investment savings accounts with us, what they get is a share of the entity that owns all of the underlying properties. And that entitles them to a share of the rental income, right? We take a share of the rental income for managing it, and our savers and investors get a share of the rental income for contributing funds towards it. Now, the way that is structured, it's a completely separate entity owned by our savers and investors. FIDA has a 1 penny share in it, which enables us to manage it on behalf of our savers and investors, but it is owned by, belongs to our savers and investors. So what does this mean? Imagine you own a company, and that company owns assets, owns properties. You have an accountant managing your company for you. It's your company, it belongs to you. If anything should happen to your accountant, do you lose anything in your company? No, right? Because that company, those assets belong to you. The accountant is simply helping you manage it. That's how we've structured it to make sure that even if the worst should happen to FIDA, our investors still own that company, still own all of the underlying assets. Now, okay, in the worst case scenario, if anything did happen to FIDA, you might need to find another accountant effectively, but it wouldn't cause you to make a loss. Does that answer the question? Yes, brother. Actually, let's take one from the sisters.
For example, if you already have regular mortgages do you take over? Is that a possibility?
Okay, so if we've got a regular mortgage, can you move across to FIDA? The answer is it depends. I know that's a very actuarial answer, sorry. If you've got a buy-to-let mortgage, so it's not the property you're living in, it's not your home, then yes, no problem at all. If it's the home that you live in, we can do it, but we don't recommend it because there is a very hefty stamp duty implication. So the way our product works, the property is owned under an SPV, a special purpose vehicle. It's just a company, right? So that property needs to be owned by that company. Now, if you have a mortgage already, that property is in your name. So to move across to FIDA, you would need to sell the property into our special purpose company, which would attract additional stamp duty on top of what you've already paid. And then at the end of the agreement, you would need to buy it back from the company, which would attract yet more stamp duty. So from our perspective, we can do it. From your perspective, it ends up being very, very expensive, unfortunately. So the reason for this, by the way, banks don't have this issue because banks get double stamp duty relief, but only banks get double stamp duty relief. Every shared ownership provider I mentioned have the same issue. We don't get the stamp duty relief. Why? Because when the tax laws were created, guess who they consulted? The banks. Right? So they were designed with banks in mind. They weren't designed with shared ownership providers in mind. So it's not a level tax playing field at the moment, unfortunately. And so whilst we can do it, we recommend against it because it ends up being very expensive. Our product at the moment works much better when you've identified a new property that you'd like to purchase.
Yeah, I've got two questions if you allow me. One question.
Speaking up a bit.
Can you hear me? Yeah. So one question was about the waiting list. So what's your criteria or maybe prioritization? If you've got a waiting list higher, how would you prioritize based on the amount of investment coming from, or is it a house or investment from the potential buyer? So that's one question. The other question I have is in terms of FIDA investment. So I'm not buying a house, but actually I want to invest on as a community person. So how would it work?
Okay, so two questions. How do we order our waiting list? And can you invest with FIDA if you're not looking to buy a home? Second question first. Yes, absolutely. We have savings products for people who are looking to buy homes, and we have savings products for people who aren't looking to buy homes, who just want to park capital, get a halal return. When your money's in a bank, the bank has a right to do anything they like with that money. They can take your money and take huge risk with that money if they want to, as long as they're holding sufficient reserves. If that risk pays off, they get all of the return and they give you a sliver of interest. And if the risk doesn't pay off and it causes the bank to fail, you as the taxpayer then have to bail out the bank. So it's a horrible system. It's designed, the whole banking system, by the way, without trying to sound too negative, the whole banking system is designed to make the rich richer and the poor poorer. That is the principle of banking, right? So we find a lot of customers, alhamdulillah, move their savings out of banks and place them with FIDA because they know that when you put your money with FIDA, your money is only ever used for one purpose. That is to help predominantly Muslims out of riba, out of debt, into completely halal home ownership. So your money's going into bricks and mortar property, and you're getting a clear profit share on the rental income. And we find a lot of our customers feel very, very comfortable with that and want to do that. So short answer, yes. If you're not interested in buying a home with us, you just want to park money, get a halal return, absolutely. Check it out on the website, inshallah. Our savings products are investment-based. So you'll see the pop-up when you enter the website. You have to tell us what kind of investor you are. If you're high net worth or sophisticated, no problem, you can go ahead. If you're not high net worth or sophisticated, then again, even though I mentioned we don't need to have an FCA license, we still have to adhere to the regulations. So if you're not high net worth or sophisticated, then we are required to ask you to take independent financial advice before opening an investment account with us, and we facilitate that. And we have an IFA partner who we can put you in touch with. So as long as you get that advice first, then after that you're free to open an investment account with us, inshallah. In terms of how we order the waiting list, we've got two waiting lists. One is the public waiting list, first come, first served, but it's very, very, very long. The other is we have a separate waiting list for people who open a particular type of investment savings account with us, which is our investment accounts are called GYS, Grow Your Savings. we've got one called GYS Home, Grow Your Savings for Buying a Home with us. So people who open a GYS Home account with us have a separate waiting list, and that is ordered based on amount invested and amount of funding required. I can't go into too much detail because I have to be very careful. I'm not allowed to promote investment products in a setting like this. But if you're interested in finding out more, please visit the website, inshallah.
Yeah. Assalamu alaikum, brother. Can you give an example, real life example? Say example, 120,000 pound, 125,000 pound property I bought, 25,000 I give, you given 100,000. What is the monthly cost for this 100,000? And what will happen if I want to sell after 3-5 years later? Is there any complications, or is there any like lots of solicitor fees involved? Normal traditional Islamic finance takes time because of these 2 transactions, sellings, and etc. etc.
Okay. In terms of getting actual figures, what I'd recommend is if you go onto our website, create a free account, and then you can go, when you log in, we've got our cost calculators there. So you can go in, put the details, and it will tell you what it will cost you, and then you can compare it to other providers as well, if you like. So I won't be able to come up with it on the spot because what we don't do is peg against interest rates, right? What we do is we look at the local rental market for your property. So it will be based on your actual property. We look at the local rental market for your property, and we base the rent on that, as well as some other business factors and considerations we need to take into account. But I won't be able to give you a blanket answer here because it will depend very much on the actual property that you're purchasing and the location and things like that. But you can go in, log into the cost calculator, and you can get a worked example there. In terms of buying and selling, if you want to sell the property down the line, there would be the usual process that you would have with a mortgage. You'd have to get another conveyancing solicitor to do the conveyancing for you. But there wouldn't be any additional complications compared to a mortgage product. The buying process with us, this is actually really important. The structure we have at the moment requires 2 solicitors, which is what you alluded to. And it does take longer than a bank mortgage at the moment. So a bank mortgage at the moment, and I want to be very honest with you guys, a bank mortgage at the moment takes 3 to 4 months. Buying a home with us at the moment, on average, takes about 6 months. It's a longer process. Having said that, inshallah, before the end of this year, we are planning to launch a new structure to address this exact issue, where it will only require 1 solicitor who can represent both sides. That should drastically reduce both the cost and also the time frame as well, inshallah.
Yeah. Last question. Yeah. You said existing customer is difficult to switch because of the stamp duty. Why is not same thing happen to the buy-to-let property?
Oh, great question. With our home provision scheme, i.e. when it's the home you want to live in, that property needs to be owned by our special purpose vehicle. With our buy-to-let purchase plan, the property stays in your name. The reason being, you're going to have your tenant living in that property. We can't take responsibility for your tenant, so we leave the property in your name, and as a result, there's no stamp duty complications. But with the home provision scheme, it needs to reside in our company, and that's why it creates the stamp duty issue.
Assalamu brother.
One more question here, and then we're going to come to the sisters, inshallah.
All right. The question is about the conventional mortgages, because you've been in the Bank of England, so you know how it works. So I just want to understand, why do the new mortgage rate apply to the old mortgage product? The question, if I want to explain.
So
why do the new mortgage rate, new interest rate,
Yeah.
apply to the old mortgage product? Like suppose 2 years ago, I bought a product from the conventional thing. The interest rate was 1.55%. The money was printed. This is I'm not on the financial side. So money was printed and handed over to the developer. I bought the house. So after 2 years, bank says, now is a remortgage time.
Yeah.
All right. So you have to choose the product, whatever it is. And the bank says, now the Bank of England has increased the rate. Now the previous money, which was printed out, which is already handed over to the developer, you have to pay. That product becomes expensive.
Yeah. Okay.
So the definition of product, I don't understand. Like suppose if I give a laptop or something as a product, and laptop has a set of price, manufacturing cost and everything costs, but after 2 years there is no other manufacturing cost. So how do this bank
Yeah.
ask for it.
So
Sorry, I'm sorry. I asked this same question with my mortgage advisor. He couldn't answer it. Then I raised this question with the FCA. FCA came back with a very astonishing reply. He says, we don't regulate them. And then
don't regulate bank mortgages.
Don't regulate the bank. I have an answer, reply there. It's very interesting, all right? I raised this question and they come up with this reply. Shocking, I don't know what is going on. My bank
It seems there were some crossed wires.
Yeah, my bank is nationwide, but anyway, that's the question.
Okay, so the brother's asking, if you take out a mortgage product, why is it after 2 years the rate that you're being charged increases? And it's because the borrowing cost for the bank changes over time. So the way the bank raises money is predominantly through their deposit accounts, so the money you keep in your bank account with them, and also through borrowing from the Bank of England, right? Now, as interest rates change, the bank will offer a different rate on their deposit accounts, especially on their savings accounts. So as interest rates go up, the bank will need to offer a higher rate on their savings accounts in order to still attract that money. And the money they're borrowing from the Bank of England will cost more as well. So because their costs are increasing, they then pass it on to their mortgage customers. So it's a simple function of how interest rates move. The bank's costs of raising capital move directly in line with interest rate movements, and that's what they then pass on to the customer.
Yeah, but our exchange with them is with the product. I bought a product 2 years ago from you,
It's
and the
because
product is sold.
the bank isn't really selling you a product; they are selling you money.
Yeah.
Right. Now, if the bank is giving you £200,000, they've had to borrow £200,000 from elsewhere, and for as long as that £200,000 is outstanding, they have to pay a return on that £200,000. As interest rates move, the return they have to pay moves in line with interest rates. And therefore, the amount they're charging you for as long as your £200,000 is outstanding will just mimic whatever it's costing them in the background. It's as simple as that.
All right. So I'm a bit insistent on it. I did a little bit research on it, where this fixed and variable thing comes up. So during the black slavery time, right, there was only one fixed rate they had. Then they recently changed this, like something 10, 15 years ago, fixed and variable. I believe there's something there which has not been, like, is it a consumer, that there are some laws called Consumer Act laws?
No, it's just a difference in bank behavior. In America, you still get lifetime mortgages where it's just fixed for the lifetime. But in the UK, the whole economy behaves slightly differently to America, and they just mimic whatever it's costing them in the background. Can we take a question from the sisters? Can we just get the mic across? Brother Nasser's just bringing the mic, sorry. We'll take a couple of questions from the sisters, inshallah.
So I've heard about primary finance from the very start, and I registered actually online to join the waiting list. And then now I know that you have to create an account for Grow Your Home Savings. So I did that, but does that mean I've lost the time that I've registered since primary finance? And is there any way to know where I am on the list?
Okay. Good question.
I have other questions, so I'll ask after.
No, that's fine. So in terms of have you lost your time on the public waiting list? No. So the public waiting list is just ordered by when you put your name on it, right? The problem is that the public waiting list is very, very, very long. And so if you want to find out when your turn is, the best thing to do is just get in touch with the team. You can email hello@fida.com and ask them. I can almost guarantee if you're wondering which turn is going to come up first, it will probably be through the savings account, right? Almost certainly, right?
Okay.
Because we prioritize that over the public waiting list. But you can just send an email to hello@fida.com and ask what's my current estimated wait time, and the team will just let you know.
Okay.
At some point, inshallah, we want to put it on your dashboard as well, so you can just go and check it.
Okay.
But in the meantime, just send an email, inshallah.
Lovely. The other two questions are, what are the criteria for the property? Do you have any restrictions? And also, does the same apply in terms of stamp duty if I'm with shared ownership and then I want to come on to FIDA?
Okay, so in terms of property restrictions, we've got FAQs on our website, and there's an FAQ that talks about the property restrictions, and it goes through in quite a lot of depth. So you can check that out, inshallah. Very, very high level. We generally don't do new builds, properties less than 5 years old, although we've just partnered up. We haven't launched this product yet, but we've just partnered up with a property developer called Modulive, and through them, inshallah, we will fund new builds. But through our own current product, we don't do anything less than 5 years old, generally speaking. Anything older than about 80 years old, we require extra surveys to be done for structural integrity. We look at the usual things like subsidence and flood risk, and we get the property surveyed and make sure the roof isn't falling apart and all that kind of stuff. But there'll be more detail on our website. Sorry, what was the second question?
If I decide I can't wait for the waiting lists, so I go with shared ownership first.
Oh, I see.
And then I want to come onto FIDA when my turn comes.
You will find the same issue, unfortunately, around stamp duty.
Yeah.
Now we're not the only provider in the market who is prejudiced by this. Every shared ownership provider is prejudiced by this. So we are working with other shared ownership providers. We're trying to lobby government. We're trying to get that tax law changed because it's very, very unfair on customers who don't want to go through the traditional mortgage route. But unfortunately, as I'm sure you know, government moves very, very slowly and laws change very, very slowly. So it's something there's not much we can do about right now. We've tried in the background to come up with fancy new structures to get around it, but we've not been successful so far, unfortunately. We've actually spent a lot of money and time and resource trying to do it, not for our benefit. It doesn't cost us anything extra. It costs you guys extra, but for your benefit, we've spent a lot of time and effort and money, and unfortunately, we've not been able to solve it so far.
Right, thank you.
Can we get another question from the sisters?
There was another question, like if we had a house and it's become a freehold, and then we want to sell it and go into FIDA, buy a property, how would that work out? And also, like the freehold, as if we were to sell it, for example, 350, and then we're looking into a property like for 400. So that 50, how would you help, or how does the process will work out?
So you've got a freehold property, presumably it's the home you're living in at the moment.
I'm just a scenario.
Okay. So if you've got a freehold property and you want to sell that in order to buy another property, there'd be no issues with that. That would just be counted as your down payment, right? So that the solicitor representing you would deal with both sides of the transaction. So as the money comes in from that property sale, they would funnel that into the property purchase with FIDA, and FIDA would just contribute the difference. So there'd be no complications.
Okay.
Let's take one more from the system, then we'll come back to the brothers, inshallah.
So, in terms of the two contracts in one, so each month there would be one payment, which is like a combination of the rental amount and the equity. Like when the actual contracts are signed, is it one contract that says you have this rent and you have this equity? And can you just re-explain how it's not
two contracts in one? Yeah, absolutely. Okay, so the contract you sign with us is a very simple contract. It's a lease contract, and it is similar to most other lease contracts you'll see. So your only obligation under that contract is to pay your rent. There is nothing saying you must buy equity as well, which in any banking contract, there will be something saying you must either repay capital or buy equity every month as well. And that's where you've got two contracts of sale and one. Our contract is a simple lease agreement saying you just need to pay your rent every month, right? Buying equity from us, even if you're buying equity every month, there's no obligation on you to buy equity every month. You can go into the web app, into your dashboard, and literally choose from month to month if you want to buy equity or not. What you're actually doing, just like when you go to your landlord and offer to buy your landlord's property and say, I'd like to buy your property from you, that is a completely separate, independent contract to the rent you're already paying to your landlord. Similarly, every month when you're coming to FIDA and buying equity, it's a completely separate offer. You haven't signed something saying, I'm going to buy equity every month. You can choose every single month whether you want to buy equity or not, and if you want to buy equity, how much you want to offer to buy. So there is no second contract around buying equity. All we do is we give you the maths. If you say, I want to fully own my home after 25 years, we do the maths and help you understand how much equity you would need to target buying every month, but you don't have to stick to it. It's purely to help you visualize your goal. That's all it is. It's just pure maths. Does that make sense?
Okay, so actually the only contract that is signed is a rental contract.
It's a rental contract. We also have something called a deed. The deed sets out how as if you do buy more equity, it sets out how your rent will be reduced accordingly. If we sell the property, how much you'll get from the property sale and stuff like that. So that is just, you know, the practicalities around it, but there is no second contract of sale, right? And this is very fundamental. It's 2 contracts of sale in one that are prohibited in Islam. So I can sign a contract with you for a rental contract. I can also sign a contract with you saying we're going to go and do a community event. That's not a contract of sale, right? So we can have 2 contracts. We can have 2 contracts in one, as long as they are not both contracts of sale.
Okay, thank you for explaining.
All right. Should we move back to the brother's side? There's a lot of hands up.
Assalamu alaikum. Would you help co-own a property that is on that first home scheme?
On the first home scheme? Yeah. So the short answer, unfortunately, is no. Generally with government incentive schemes, this includes right to buy, first home, all of that. They require the property to be entirely in your name. So with our product, unfortunately, because it's in the name of a company, it's not eligible. Same for lifetime ISA and these other incentives. Now we are working on a solution. We think we may have a solution to be able to take advantage of these schemes, inshallah. But right now, the answer, unfortunately, is no.
So if someone had a life ISA, you wouldn't be able to use that deposit to
Unfortunately not, because again, the definition for a lifetime ISA, it just never envisioned these types of products. So it only is, the bonus you get from your lifetime ISA is only eligible if you're buying your first home with a mortgage, right? That's how it's defined. And it's just because it never envisioned these types of products. So unfortunately, it wouldn't be eligible at the moment. Again, we're working towards a solution to try and resolve that.
So just last question.
Barakallahu feekum. Jazakumullah khairan for coming.
So what's the minimum amount you can put into a GYS that would raise you up the scales on the waiting list? That would you say?
So if you're talking about GYS home, you can start from £1,000, inshallah. But again, on our FAQs, we've got a whole waiting time matrix based on how much funding you need, how much down payment you can put in, and what the estimated wait times would be based on.
And in terms of the equity, sorry, you can do that anytime. You can buy as much equity.
Anytime you like. Oh. Yeah.
For example, when you calculate the rent, you said it's based on the local market. So sometimes if I come back and I negotiate that rent saying it looks a bit high for me, or I mean, for example, if I don't agree with that rent, what will happen?
Okay, really, really good question. I'm glad you asked. There is, again, an FAQ on our website that talks about how rent is calculated and how rent is reviewed on an annual basis. And I encourage you to check that out. The way we set the rent up front is we will look at the local property market. Now, there's no precise science here because in some areas, the rental market is very fluid and in some areas it's not, and you've not got much data. But we'll get the property surveyed. We'll come up with a high, medium and low estimate for what we think the rent in that area should be for this property, right? Now, our mission when we set the rent we're charging you is we want to fit within that reasonable range. We also need to make sure we're making money as a business. So we also need to look at what do we need to actually charge to make money, right? Now, in an ideal world, the amount we need to charge fits within that range and we're both happy. There may be instances where we come out at the bottom end of the range, and we have got instances like that because the amount we need to charge is no higher than the bottom end of the range. There may be instances where we come out at the middle of the range. There may be instances where we come out at the top of the range. And there will also be instances where we will say, look, this is the amount we need to charge for this transaction to make sense for us as a business. So we're not losing money, so we're actually making money on it. Now, that may be higher than the range of the market. And then it's up to you to say, are you happy to still proceed or not, right? But we will tell you this is what we need to charge to make this deal viable. Are you happy to proceed? And you might say, no, I'm not happy with that. And then we can try and find a different property where we can fit within a reasonable range. But that's ultimately how a partnership works. Both partners have to be happy before proceeding. Now, on an annual basis, the way the rent is reviewed is completely mechanical. There's no subjectivity whatsoever. So our tech is plugged into land registry sold property price information. And on an annual basis, what our tech will do, it will look at sold house price information in the postal area of your home. And it will say, okay, if property prices are going up, your rent will move in line with property price increases. If property prices are going down, your rent can also move down which most landlords would never do. And it's capped and collared, so it never moves by too much in any given year. So the way we restrict the rent review is the impact on your total monthly target payment should never be more than 1 or 2% in any given year. And we target 1 or 2%. Who can tell me why? Why 1 or 2%? We talked about it, touched upon it earlier. Long-term wage inflation. So by making sure that your total monthly payment never changes by more than 1 or 2% in any given year, we can be fairly comfortable that your total monthly payments are moving roughly in line with wage inflation, and it should remain roughly affordable to you over time. But the way rents are reviewed over time is completely mechanical. There's no subjectivity whatsoever.
And when you have a GYS home product, so let's say like someone has the investment savings and he's got the 9-month waiting list, is there anything can happen where that 9 months can go longer?
Yeah. So the 9 months is a minimum, by the way. That's about the fastest we can do. But when you look at our FAQs on waiting times, there'll be a big bold piece of writing underneath saying these waiting times are estimates and they can change. Because from our perspective, how are we operating? Again, you have to realize we're not a bank. We're not funded by a bank. We're community funded. So the way it works is we project based on all of our past experience how much inflows we think we're going to have over a period of time and how many customers we can serve in those inflows and how fast customers are going to move and buy properties. And it's based on all of that. Now, all of that is al-ghaib, right? We don't know it with certainty. These are our predictions. On average, we tend to be reasonably good at sticking to our estimates, right? We don't generally tend to miss them by much. Sometimes we reach out to customers slightly ahead of schedule. Sometimes it might be slightly later than predicted, but generally it's not very different to our estimates. But they are estimates, and that's something you need to understand and be comfortable with. They're not guarantees.
Assalamu alaikum, jazakumullah khair. It's just a quick question to ask FIDA, is it a community interest group or limited liability?
Is it what, sorry?
Community interest group or a liability company?
Really good question.
And
so,
second question, do you have any maximum in terms of, let's say, investment or minimum?
Two great questions. Yeah. So the brother asked, is FIDA a community interest group or a for-profit limited liability company? And is there any maximum on investing? So when I was setting up FIDA, I very nearly set it up as a community interest company, as a not-for-profit effectively. The only reason I didn't, and it's because FIDA was set up with a mission to help Muslims into home ownership, help Muslims avoid riba and debt. For me, it wasn't about the business opportunity. For me, actually, and I will answer the question, but I think it's really important to understand why I set up FIDA. I set up FIDA because I went on Hajj and I felt I had a responsibility because I had the skill set to do it and nobody else was doing it. I felt it was a fard kifaya upon me. I had to do it. I did it grudgingly. I didn't want to do it. That is my honest truth. I was in a very high paid role in the City of London. I was very good at what I did and I had no reason to leave. If FIDA was about making money, I would have just carried on doing what I was doing. I earned multiples of what I'm earning now. No joke whatsoever. There were times in my career, alhamdulillah, as an actuary, where I was earning more money than I knew what to do with. Wallah, that's true. Alhamdulillah. That is the background I've come from. I'm very, very blessed in my life. Alhamdulillah. I have been, at least. So for me, FIDA wasn't about identifying a business opportunity to make money. For me, FIDA was about sincerely being able to say, Allah, I tried. I tried to do something with the skill set you've given me to please you. That's what FIDA is about. I can't remember what the question was. So sorry. Maximum investment. There's no maximum investment. You can invest as much as you like with us, inshallah. But what was the first question? Is it a community interest group? Yeah, okay. The only reason I didn't set it up as a not-for-profit is because it's easier to raise funding as a for-profit business. That's the only reason. But I very nearly set it up as a CIC. Yeah. Let's get the mic across. Okay, one more question here and then we'll bring the mic across.
Yeah, thank you very much. First, let me just appreciate you for this initiative. Jazakumullah khair. And my question is, I'm just trying to understand the implication of my saving on the wait time of the waiting list. So my ask is, does my savings influence does it prioritize my waiting list?
Yeah.
Or let me expatiate more. For instance, now, let me just bring the general hypothetical case that we have in the school. When you are in the waiting list, school consider children of staff, which now I see in your case, you consider those having savings to grow more than the public. I just consider it like that. Then again, those ones with the proximity to the school and those ones with the seedlings.
Yeah.
They have priority over others, regardless of when they have joined the waiting list. So what I'm trying to ask now is, for instance, now, if myself and Raza are in the waiting list, and Raza was number 3, and now my savings so far is more than Raza's savings, would say 50%. Does that push me ahead of Raza?
Okay.
That's what my question is.
Yes, to an extent. Let me pose a question to you. If you and Raza are in the waiting list, and Raza has £1,000 saved up, and you have 20% saved up, does it make sense for me to say to Raza, right, we're ready to serve you now? No, because he's not ready, right? So the way we order our waiting list is, if we can see that you're ready, if we can see that you've got your down payment ready, then we know it makes sense for us to prioritize you over someone who clearly doesn't have their down payment ready. So the waiting list is ordered by the amount you've put in and the amount you need from us as well. Two key factors. How much funding do you need from us? If you need a little bit of funding, we can serve you quicker. If you need a lot of funding, it's going to take longer. And how much have you contributed to the pool? What we're trying to really encourage here is what we call Ummah mentality. So rather than people coming into this, as I mentioned, this is a community initiative. It is entirely fueled by you guys, the community. I encourage you guys, going back to your question, not to think of us as a business. Even though we are a business, we are a for-profit business. I have to be very clear about that. But not to really think about us as a business. Think about us more as a bunch of bros who got together to try and do something useful for our community. That is how I see FIDA. This is us trying to bring the community together and try and do some good for the community. That's all I want to achieve with FIDA. So the Ummah mentality I'm talking about is, rather than everyone coming to FIDA and saying, right, what can I get from this? How quickly can I get served? How much funding can I get? And how can I get into #1 spot in the waiting list? What we try to encourage is everyone to go, how can we all support each other? How can we all contribute to this initiative? How can we all benefit each other as well as ourselves and uplift the entire Muslim Ummah together, inshallah? And the question I like to